Welcome to the Opening Bell Report.
Okay, I want you to picture the scene. It's Thursday morning, February 5th, 2026. You're settling in, you've got your coffee, and you unlock your phone to check your portfolio.
Oh, that first look in the morning.
Yeah, just a quick peek, and immediately you wish you hadn't.
A sea of red.
It wasn't just red, it was a crime scene. And for anyone holding NBIS group ticker, NBIS, it was a spill your coffee kind of morning. The stock didn't just dip, it plummeted over 10% in a single day, closing at $73.87.
Which, let's be honest, is a gut punch. A double-digit drop like that is visceral. It triggers that primal part of your brain that just screams, something's broken, get out.
Exactly. My first instinct is always to run for the hills. Sell it all, ask questions later. But then I sat down with this stack of new research we have for today's deep dive. And the headline wasn't panic.
Not at all.
It wasn't the bubble is burst. It was, well, it was confusingly optimistic. One analysis report literally calls this drop the gift you were waiting for.
Talk about a contrarian take.
Seriously. So that is our mission today. We are going to unpack this massive disconnect. On one side, you have the market voting with its feet, dumping the stock. On the other, we have this investment thesis claiming NBIS has over 100% upside from here.
It's a classic setup. We need to figure out, is this a falling knife that's going to cut you if you try to catch it, or is this a genuine dislocation, a golden opportunity disguised as a disaster?
I have to say, I'm going to play the skeptic today, because when I hear 100% upside on a stock that just crashed, my alarm bells are ringing. You're going to have to convince me this isn't just throwing good money after bad.
Challenge accepted. I think the key here is distinguishing between a broken stock and a broken company. Those are two very, very different things, and the best opportunities, they usually live right in that gap.
Okay, let's start with the crime scene then. Minus 10.34%. That doesn't happen. What was the trigger? Did a data center burn down? Did they lose a huge client?
See, that's the fascinating part. If you dig into the operational reports, the answer is nothing.
No.
Absolutely nothing changed in the business. No customer churn, no supply chain disasters, nothing. The analysis report attributes the crash entirely to macro sentiment. It was a classic risk-off day.
Risk off. We hear that a lot. But, translate that. What does it actually mean for the stock?
It's sector rotation. So basically, big institutional money, the hedge funds, they decided to take chips off the table in tech and AI specifically. Maybe they're worried about inflation, maybe geopolitics. When that tide goes out, it pulls every boat down with it. NBIS just got caught in the current.
Okay, but 10%. That seems extreme just for sentiment, even for a tech stock. Apple doesn't drop 10% on a bad mood.
It is extreme, but it's also characteristic. The analysis highlights that NBIS is what we call a high beta stock.
Let's pause on that. High beta. For anyone listening who hasn't taken Finance 101, break that down for us.
Think of the S&P 500 as a massive cruise ship. It's stable, it turns slowly. NBIS isn't a cruise ship, it's a speedboat.
Okay, I like that image.
Beta just measures how much that speedboat bounces relative to the waves. So a high beta means if the market drops 1%, NBIS might drop 3% or 4%. It just amplifies the market's mood swings.
And it works both ways. Right?
Exactly. When the market is happy, high beta stocks soar. When it gets nervous, they crash. The analysis argues that this 10% swing is simply the price of admission for a company with triple-digit growth. If you want the rocket ship returns, you have to have the stomach for the turbulence.
So volatility is a feature, not a bug.
In this specific asset class, yes. And if you look at the technicals in the report, this drop didn't happen in a vacuum. The stock fell right into a historical support zone.
Support zone, meaning a price where buyers have shown up before.
Right. Between $68 and $72, there's been a consistent pattern of heavy buying. Closing at $73.87 puts us right on the doorstep of that floor. The algorithms and the value investors, they tend to wake up around these levels.
Okay, so the floor might be solid, but let's talk about the ceiling. Why should we even care about this specific speedboat? The report calls this Pillar 1 the math of hypergrowth. I saw a number in here that I honestly thought was a typo.
Let me guess. The year-over-year revenue growth.
Yes. We're not talking 20 or 30%, which is usually considered high growth.
No. We're looking at revenue growth of greater than 400%.
400%. Yeah. That is just wild. Most companies throw a party if they hit 15%. How is that even sustainable?
It's driven by the, insatiable demand for AI infrastructure. Compute power is the new oil. But the really critical part isn't just last year's growth, it's what they're guiding for. Management is aiming for an annual recurring revenue ARR of $7 to $9 billion by the end of 2026.
$9 billion in recurring revenue. That's a massive amount of cash flow.
It is, and this is where the skeptical part of your brain should perk up, because usually when you see that kind of growth, the stock is priced for perfection. You'd expect to pay a huge premium.
Right. High-flying AI stocks trade at, 20 times sales? Sometimes 50 times? You pay a lot for that growth.
Exactly. But let's do the math on NBIS based on yesterday's close. The market cap is roughly $18.6 billion.
Okay, so $18.6 billion valuation.
If they hit the lower end of their target, just the $7 billion in revenue,
No, even the high end.
the stock is currently trading at roughly 2.6 times its 2026 sales.
Wait, 2.6 times.
2.6 times.
That just doesn't sound right. The big data players, NVIDIA, they trade at multiples 10 times that. Why is it so cheap? Is this a too good to be true situation?
That is the core question of this deep dive. The report calls it a massive valuation disconnect. Competitors trade at 10x, 15x, even 20x sales. To find a company growing at 400% trading at 2.6x is, to quote the analyst, dirt cheap.
Okay, play devil's advocate for me. Why would the market price it so low? Is there something wrong with the product? Maybe their tech isn't as good as AWS or Google.
And that leads us perfectly into pillar 2, the AI factory moat. Because you have to ask, is NBIS just another generic cloud provider?
I saw that term AI factory in the notes. It sounds a little like marketing fluff. What does it mean?
It's a crucial distinction. A generic cloud provider gives you virtual space, like renting an empty warehouse. An AI factory implies vertical integration. NBIS owns the full stack.
Define full stack for us.
They design the data center architecture themselves. They own the proprietary racks that hold the servers. And most importantly, they own the software stack that runs the training jobs. They aren't relying on someone else's plumbing.
So it's the difference between renting a generic apartment versus building a custom house for exactly what you need.
Precisely. And in AI, what you need is low latency, speed. If you're an AI startup burning millions a day to train a model, efficiency is everything. Because NBIS controls the whole environment, the report claims they can offer lower latency and better pricing than the hyperscalers like AWS.
That's a bold claim, beating Amazon and Microsoft. But what about the hardware? You can build the best factory, but if you don't have the machines.
The machines in this case are NVIDIA H200 chips,
The gold dust of the tech world.
the scarcest commodity on Earth right now. And the report confirms NBIS has secured massive allocations of H200s.
Which is a huge deal. I mean, I keep reading that startups are fighting just to get compute time.
That's the supply chain victory the report talks about. By having the hardware in hand, NBIS is winning business from startups who simply can't get that computing power anywhere else. They have the water in the desert.
So they've got the chips, they've got the factory. But let's talk about the elephant in the room with these companies. Cash burn. Usually a company growing this fast is just lighting money on fire.
That is the #1 killer of growth stocks in a high interest rate world, debt. If you have to borrow at 8%, your margins get eaten alive.
Which brings us to pillar 3. The report calls it the cash fortress.
And for good reason. NBIS has approximately $2.5 billion in cash on its balance sheet.
$2.5 billion. Where did that come from?
No, and this is unique to their story. It came from the Yandex divestiture. It's just cash in the bank, unencumbered.
So they don't have to go hat in hand to Wall Street.
Exactly. Think about the strategic advantage of that. If a competitor needs more GPUs, they might have to issue more stock diluting you, or take on what the report calls toxic debt. NBIS can fund their massive capex directly from their own savings account.
That's a huge safety net. They can weather a storm.
It turns them from a fragile growth stock into a resilient one. They have the fuel to keep the engine running.
Okay, so let's look at the scoreboard. We have the fundamentals, the moat, the cash. But we started this conversation with the price, $73.87.
The disconnect?
The disconnect. What do the pros think? The analysts who do this for a living, are they as scared as the market was yesterday?
Not even close. And this is the reality gap the report highlights.
Right.
The average price target from analysts covering the stock is $154.31.
$154.
Over.
That's more than double the current price. Over 100% upside.
And that's just the average. The bull case target is $221. That's almost 200% upside.
Is anyone saying sell?
Currently, 86% of analysts rate it a strong buy. There's a quote in the report that I think sums this all up perfectly. It says, "The market is pricing NBIS as if it will fail to deploy its GPUs. Analysts are pricing it on the reality that demand for those GPUs is infinite."
That is a powerful distinction. The market is trading on fear. The analysts are trading on the math.
Precisely.
Okay, but here's the million-dollar question. If I buy today, am I going to have to wait 3 years for this to play out? Is there something on the horizon that could move the needle soon?
You won't have to wait long at all. In fact, there's an immediate catalyst. February 12th, 2026.
Next week.
Thursday. Pre-market earnings.
Woo, earnings. That always makes me nervous. We've all seen stocks drop 20% on earnings. If they miss, this could go from $73 to $50 real quick.
It can be scary, absolutely. But remember the setup. The stock has just sold off 10%. It has effectively lowered the bar.
Explain that. Why is a lower price better going into earnings?
Expectations are just dampened. If the stock was at an all-time high, they'd have to deliver a miracle. But since it's already been beaten down to 73...
They just need to not trip over their own shoelaces.
Exactly. If they simply meet expectations and reaffirm that 2026 guidance, the report predicts a violent relief rally. Think of holding a rubber band underwater. As soon as you let go, as soon as the uncertainty lifts, it just snaps back up.
Is there a specific metric we should be watching for on the 12th?
Yes. Watch the GPU deployment rate.
GPU deployment rate. Why that?
It measures how fast they're actually plugging these chips in for customers. It's the metric that proves the AI factory is actually working. If that number is ahead of schedule, the report suggests the stock could reclaim $90 plus practically overnight.
90 overnight. That's a significant jump.
It is, but that would just be returning to where it was before the panic. A mean reversion.
Okay, let's be practical. The report's verdict is strong BAI. Big green circle. But how does it suggest we actually enter the trade?
It outlines two approaches, depending on your personality. Aggressive or conservative.
Let's hear the aggressive one first.
The aggressive strategy is to buy at market open, right around that $73, $74 level, basically saying the discount is here, I'm taking it before it bounces.
Don't overthink it, just buy the dip.
Right. But the conservative strategy is more tactical. It suggests setting limit orders around $70.50.
70.50. Why that specific number?
It's betting on a final capitulation wick.
A what?
A capitulation wick. It's that brief moment at the open where the last few panic sellers just dump their shares at any price. It pushes the price down for a second before smart money steps in. It's trying to catch the absolute bottom.
Okay, that makes sense. Snagging a bargain from the fearful. But we have to talk about risk management. What if we're wrong?
The report is very clear on this, and I love that they included it. You need an exit. The stop loss level is a weekly close below $65.
$65. That's the line in the sand.
If it closes below $65 for the week, the technical setup is invalid. The support zone has failed. That's your signal to get out and reassess. Don't be a hero.
I like that discipline. It takes the emotion out of it.
Exactly. But I think we should circle back to the core narrative here. It's not just about a 10% swing or a 2.6x multiple.
No, it feels bigger. When you stack up the cash, the chips, the software, it feels like we're looking at a company building the literal engine room of the AI revolution.
That's the view. We are in the early innings on a major technological shift. And NBIS is sitting there with the hardware and the cash to be a major player. They're selling the picks and shovels during the gold rush.
And the market just handed us a huge discount because of a bad macro day.
That's the thesis. It's a washout of weak hands. People selling because they're scared, not because the company is bad.
You know, usually I get nervous when things drop this hard. But when you lay out the math, the growth, the valuation gap, it starts to look less like a crisis, more like an opportunity.
It raises a question for any listener. Are you trading the price action of the last 24 hours? Or are you investing in the business reality of the next 24 months?
That's a great way to put it. We get so caught up in the daily noise.
The analysis report ends with a thought that really stuck with me. It says, in 2027, you won't care if you bought at $73 or $78. You will only care that you owned it.
That really puts the volatility in perspective, doesn't it?
Woo.
We're quibbling over a few dollars now, but if the thesis holds, those dollars won't matter.
Exactly. The difference between 73 and 78 is noise. The difference between owning the AI infrastructure winner and missing out. That's the signal.
Well, I think that is a perfect place to leave it. We've unpacked the panic, the three pillars, the AI factory moat, and the upcoming catalyst. It's certainly going to be a high-stakes week for NBIS Group.
Definitely one to watch. I'll be glued to the screen on the 12th.
Same here. For everyone listening, remember, those earnings are February 12th, pre-market. So do your homework, digest these numbers, and decide if you want to be on the aggressive side, the conservative side, or just sit this one out.
No shame in sitting it out if it's too hot for you.
Absolutely.
Right.
But whatever you do, don't just ignore the red numbers. Sometimes that's where the gold is hiding. Thanks for joining us on this deep dive. We'll see you on the other side of that earnings report.
Take care.
Don't forget to like, share, and subscribe for more.